Wonderful. So, hello, everyone. It's fantastic to see you all here. Thank you so much for joining us this afternoon. It is a full house today, so pleasure to have you all here. Thank you so much. As you may know, my name is Laura Nieves. I am proudly responsible for Astor's investor relations and operations. So today I'm very excited that we are going to present to you our newest investment opportunity in the very, very popular and hot market right now of Dallas-Fort Worth, Texas. So during the presentation, we will have the opportunity for questions to be answered. So please feel free to drop them into the chat in your Q&A option down there. We will do our best to get them answered. And if for whatever reason they do not get answered during the webinar, you know I will be reaching out to you after to address them with you. Okay, so before we start today, I would like to share a couple of words about who we are. So Astor Realty Capital, we're an institutionally backed private equity firm. We are led by a seasoned team with a solid commitment to the growth and preservation of our investors' capital. Astor's diversified real estate portfolio spans over 3.6 million square feet, valued at over $2.27 billion in 12 major US markets. We achieve exceptional risk-adjusted returns for our investors that proudly surpass industry standards. Today, I am proud to introduce our presenter, Joe Burko. Joe is the founder and CEO of Astor Realty Capital. He's a nationally recognized entrepreneur and visionary with over 25 years of success in the real estate, finance, and investment banking industry. Joe, for his creative methodologies, has earned multiple prestigious awards, including CoStar's Power Broker, New York Signature Broker by Globe Street, and has also been appointed advisor to the New York State Real Estate Board by 2 New York governors, where he served for over 9 years. So on that note, I am proud to pass you over to Joe. Joe, are you there?
Yes. Thank you very much for the introduction. Hi, everyone. Good to see you. It's been a little while. We've been a little quiet for good reasons. You know, as you all know, the market has been in turmoil. We've actually started taking a bit of a slow pause earlier last year and sort of come to almost a complete stop. last year, watching how the Feds are literally taking a sledgehammer to valuations of all asset classes. Real estate are not is not the real estate sector is not immune. And so with the understanding that interest rate going up, values will ultimately get eroded or reduced. We wanted for things to settle. It looks like things are settling as of today. Alex, our dear analyst, has informed me that the Feds have increased rate by 1/4 of a point. They've been very steady with what they're saying. But on our stand of things, we realize that if we're stepping into the market and operating as if business as usual, things will not look out that great. And so we've taken a pause. I've taken almost a 9 months pause. I've been focused on our own assets, on our own portfolio, which have grown quite tremendously over the last couple of years, post-COVID. We're now running over 3.6 million square feet in multiple states and multiple markets. Thanks to you, our investors. Thank you for your faith and thank you for your trust in our operations and what we're doing. We've also had multiple successes and exits. And so we're looking forward to sort of like dive back in cautiously, but we're ready to dive back in. So why are we doing that? Looking at a few factors, we always try to understand the market and anticipate where things will be going. Essentially, looking backwards, and it's only easy to look backwards. Whoever tells you otherwise is really not telling you the truth. Nobody has a crystal ball, but looking backwards, we can actually at this point look to see where is the apex, where's the high point of the market. And the high point of the market was 1 year ago exactly, it was March of 2022. And so we've been a year into a slow decline, and lastly, in the last couple of quarters, a much faster decline. In property values, transaction volumes is down, obviously harder to get money. And of course, what we've seen over the last couple of weeks with bank runs is essentially the kind of environment that you expect to see when you're hitting the bottom. So I think we are at the bottom. Nobody can say that we're absolutely there. It could be a little bit more pain going over the next quarter, maybe the next couple of quarters, but we certainly are looking at the bottom. The second thing is we're looking at construction starts, right? How much competition we're going to have going forward for every market we look into. We study how many construction starts, how many buildings will come all around our building, and how many units will come online, and how much competition, and is it going to be oversupply? Are we still okay? So we always look at a lot of those studies. Looking at the last quarter, construction starts, which represents new construction projects, have been down across the United States by 50%. Values have dropped by all sectors by 14%, construction starts down 50%. It signals for us a couple of things. One of them being we're looking into an environment that, although we are living through an inflationary environment, and now it's 7.5%, we're essentially looking into a time and where large construction companies will be looking out to sign up their next projects. There will be less demand for material. There'll be less demand for labor. And so we're going to be able to negotiate better both on those two items, which will essentially translate to lower cost altogether. The second thing that we care for about is when construction starts is low, 3 years from today, when whichever project we go into is going to be ready to be sold, our project will have very limited competition. And so this is kind of like a macro scale of things. But going into our project today, let me ask Laura to share the presentation and we can go through it. Okay, we got it. Thank you. So in our presentation today, what we have to offer you is preferred equity investment opportunity. Essentially, preferred equity represents capital that it gets to be infused into a project that is accelerated from the common equity. In this particular case, what we're doing here, and I'll try not to go too deep, give you some time to ask any questions if there's any, and of course, any conversation that you want to have with me or any of our team members after the Zoom in private, we're happy to do it. So let's go over the story itself. So last year, we've acquired a complex in Texas, in Dallas-Fort Worth, one of the submarkets called Arlington. So Arlington is actually perfectly located between both of those two major cities, Dallas and Fort Worth, there's a connecting highway called Highway 30. Arlington is sort of like middle of the way, between Texas and between Dallas and between Fort Worth. Why is that important? Because when two families are occupying a space, one may be working in Dallas, the other one may be working in Fort Worth, it makes perfect sense because they'll be traveling somewhat of a similar distance. And both of those markets, obviously, Dallas Fort Worth is growing exponentially. So we've acquired this property for roughly about 27 million and change. We've bought 205 units, 186,000 square feet. And we've taken debt roughly to the tune of $21 million with some reserves amounts, and with cost overruns for maybe some deferred maintenance, and with interest rates spiking up tremendously. Although we bought some insurances, there's still some cost overruns that we need. So we were able to come out of pocket with additional capital from the total partnership. We started again a partnership with $8.9 million. We're now, I think, at around 9.4, and I think we'll go all the way up to as much as $10 million to get our total partnership. That will be the equity cushion. I'll explain what the equity cushion in here is in a moment, but that will be the equity cushion. So that will be sort of like the first loss money in the event of whichever default or anything that may risk the position of you, the preferred members. What we're looking for is a short-term preferred, 18 months. It's a form of a corporate loan that will be at a 12% with 8% current. In other words, we'll pay quarterly or monthly, depends on your choice and the check size that you'll bring to the project or invest in the project. We'll pay 8% throughout the year and 4% at the exit for a total of 12. That will be that's the absolute net to you, the investors. That's basically a description of what we're doing. So we bought the property. The idea was we bought the property with a very, very low in-place rent. Very low in-place rent, way lower than a lot of the other properties. Why is that? It's a little bit of factor of a number of reasons, not the best management in place, and things of that nature. And sometimes when you have a legacy management, Texas was going through unprecedented growth, both in rents and both in population and in demand and everything else. And not every management company have picked up on those demands, and some felt kind of like, kept things behind. So our idea was to come in, improve the properties, improve the units, and increase the rents, therefore increase the value, and then sell it off in a couple of short years, 2-3 years is usually what we're looking for. And so in this case, as I said, we'll looking to infuse additional capital to the project in order to improve and do all the business plan that we were thinking about doing, improve occupancy, change some of the residency. Some of the residencies have been legacy tenants that were not the most desirable. And so that has been going on for the course of a year. And now we're looking for a second round of capital in order to finish this final hump and get us to the finish line. Some general pictures about the asset. It's a Class C. It's called workforce housing. So, it's a 1970s product. So it has about good 45-50 years life on this asset already. It's open grounds, it's multiple buildings, it has a nice little swimming pools, it has areas for barbecues and areas for dog walks and things of that nature, dog runs. Quite a nice little asset. It is a simple asset though, right? It's the kind of asset that, working class individuals will come and rent an apartment for families. The vast majority of the units are 2 bedrooms. We have a mix of some bedrooms as well, but the vast majority over here is 2 bedrooms. So we have a lot of families and working class families, and they find this place to be pleasant, and they find this place to be kind of like ideal for their pocket size. This is a picture of the model units and how the units will look like in the interior. Simple finishes, however, quite nice and clean. That we are in the process of. Some of them we've been renovating over the course of the year. We're able to increase rent quite significantly, and others we were and others, we still have some time in order to finish the work. We still have about over 100+ units that we can renovate. In terms of timeline, as I mentioned, we bought around March of 2022. Throughout the year, we've done around 60 units, some of them very heavy renovations, others lighter renovations. We have another aspiration to renovate an additional 100 units, increase the rent, keep on working on the occupancy, and make sure that things are working smoothly so we can exit the asset when market condition improve. What does it mean, market condition improve for us? Market condition improve means a little bit of a lower interest rate. Right now, it's in a higher interest rate environment, and all indications are showing that eventually, after maybe one more quarter raise, the Feds will start kind of like tapering off and then slowly coming down. So we believe that sometimes in a year from today, certainly third quarter of 2024, we expect a very different environment economically. And so around that time, we believe we can sell the asset and exit in a reasonable return. However, the conversation here, again, it's what we call the preferred position. So let's take a look at the capital stack. We have our senior loan of about just shy of $21 million. The preferred equity is going to be reduced. We're not going to take $2 million. We'll take some of the money from the reserve account that we have from the bank, some of the money from the partnership total together. And I think we'll leave around $500,000-600,000, the maximum probably $700,000 for you, our friends and family, to participate in a preferred equity coupon, cushioned by about almost $10 million of common equity by experienced groups. I'll talk about the groups in a moment or so. And so, you know, from a risk-adjusted standpoint, the question that you, the investor, has to ask yourself is, what's the risk factor that I have if I'm investing in this asset? Well, the risk factor, in our opinion, is significantly low, and therefore we're happy to produce a 12% with a very low risk-adjusted return. Now, why do I say it is a low risk-adjusted return? You know, our projection are, and I'll talk to you about those in a second. Our projections are to achieve around 3.5, just shy of 3.475, roughly, of gross potential rent. Okay, if we can push rents all the way up to $1.55, averaging around $1,400 a unit, we'll reach about, $3,470,000. We have other incomes that we charge the tenants. It's another $500,000 roughly, taking out about 8% occupancy and collection loss and so on. We think we can achieve a $3.6 million effective gross income. Operating expenses are running at around $1.7 million, which leaves us a stabilized NOI of about $1,936,000. Okay, so about just shy of a 6% yield on cost. Forward NOI, I think, we'll be looking into year 3, which we do a 1-year forward NOI. We're looking into potentially a 5.25% cap rate sale at that particular point in time. Mind you, the asset will be in much better conditions. A lot of the units are renovated, and kind of like 5.25, maybe 5.5 if we want to be more conservative. We've seen situations where assets like this were trading for much higher amounts, for cap rates that were much more compressed, 4.75, 4.6, 4.5. But we're saying 5.25 for now. So we're assuming that we'll sell for around $37 million after cost of sale. We'll net around 37.2. Repay back the debt. There's a little bit of a exit loan fee that we have to pay the bank, pay back the preferred investors, this is you, and return of escrow funds of $250,000, and essentially be left with about a total profit, bottom blue, of $4.6 million over a course of 30 months from inception, not from now, from inception. We started about a year ago. So for our investors, they'll be making around 20%. And then they'll have to pay a little bit of a promote fee to us. But essentially, this is where we think the deal will stabilize, and that's where the deal will generate. Since you're coming into this and you're reducing the risk, right, then your last dollar exit will be at a much better position, right? And that's where the conversation is. We can talk more about that. So as an example, as I mentioned, we're no longer looking for $2 million. We're going to be raising some of our money. We're going to go into our pockets ourselves, which is, by the way, a great sign when you see the ownership is coming in and bringing more capital. The bank is going to give us a little bit more capital to operate, and we're only going to look for about $500,000-600,000. An investment amount of about $50,000, which is the minimum investment that we're looking for right now. Can be some exceptions. We can talk about those, but at the moment it's $50,000 at a minimum. For a course of 18 months, generates $9,000. So the investor gets back $59,000. That represents 12% a year and 18% in total for the investment duration. You have another projected return, essentially how we're breaking down everything. There's no fees that we're taking from the investors at this particular investment. Some information about the unit mix that we have down right now. The units are composed, as I mentioned, 205 units altogether. And we are looking at an average lease for the one bedrooms around 1,000. We can do better. And then some of the better units are achieving higher rents, and so on and so forth. So our objective is to renovate, bring it up to an acceptable level, nice level, pleasant place to be and live. And the demand is certainly very much there. Now, pay attention to this, $1.29. $1.29 essentially represents for us the average rent that we're collecting today between the older units and the newer units and so on. Most of the complexes we're tracking right now, it's always very important in any business you are to track your competition, right? To see what the competition is doing. What can you learn from them? What exactly are they doing that you're not doing that you should be doing, and so on. So we always choose the group leaders, okay, the best in class group leaders, but in our range, right? I'm not going to compare this asset to a brand new apartment complex. I'm not going to compare it to something that was done or built 10, 15 years ago. I'm going to compare it to a similar asset class, 1970s, kind of like similar makeup and location. So those are the ones that we are tracking. The better ones are doing significantly higher. I mean, significantly higher. We're talking about $1.70 a square foot, right? So just to give an explanation, what does it mean for us if our, 2 bedrooms are running 1,000 square feet? I'm looking at the bottom of the average square footage. If 2 bedrooms are running around 1,000 square feet and are generating for us around $1,200. We know that the better ones out there are as able to generate as much as $1,500, $1,600, and even higher. Okay. Some of them are a little bit smaller, so dollar per square foot is skewed, but we certainly have a lot to push for and a lot to hope for. We have more comparables here. These are some of the ones we're tracking, as you can see. We track it based on, one bedrooms. The left one, the Junction, is our subject property, right? And so on and so on. More about rent projection calculations. Of course, anyone who's interested, will send you the package. You can go over it and we can go over it together. If you have more questions, I'm happy to do that. A little bit about the location. As I mentioned, the Junction is located about 20 minutes away to Dallas and about 20 minutes away from Fort Worth, two very major central employment areas. Arlington itself is a nice center employment area in itself. You got big companies there. But it's sort of like, a much, much easier lift if you're a blue collar family and you're looking for where, a place to live and work. The Junction in Arlington represents a fantastic opportunity, right? We're still close enough to the airport, 20 minutes away from the airport, one of the major employment centers in this area. And so strategically, I think that Arlington is, for this type of an asset, is located exactly where it needs to be. Dallas is very expensive for renters. Fort Worth is very expensive for renters. Arlington sits exactly sandwiched in between, 20 minutes away from everything, 25 minutes. There's the Fort Wayne, Arlington is known for the home of the Dallas Cowboys, which is a mega event. It brings, tens of thousands of families and kids. And a lot of money is spent in Arlington for before the game and during the game and after the game. We also have other such as the Texas Rangers are right immediately there in Arlington, and then we have large corporate centers that have found Arlington to be a great place for them to operate. According to surveys, in terms of commercial real estate investment, you can see that Dallas Fort Worth, based on 2023. is one of the most sought after locations in the United States for investments. Why? Because it's great opportunity for any sort of business, right? It's a growth region. We're talking about an area that has been growing at an 18% in population. That's unprecedented. If you look at those two figures, number 4 and number 5 in the U.S. largest metros, the growth that we're seeing in Dallas, Fort Worth, and in Houston, 18.5%. It's an unprecedented amount, and the demand for housing is just going through the roof, which is again the type of areas that we're all seeking to enter and to conduct our business. It's also a very business-friendly area, and so tax-wise, political climate, anything you can think of. For us, it's an interesting. So a lot of our attention is spent on those areas. In terms of affordability, right? So it sits somewhere nicely in the middle. We can obviously see New York and Seattle, San Francisco, kind of like leading the pack with cost of living going through the roof. Dallas, Fort Worth is still doing really well somewhere in the middle. Not the cheapest, but certainly far away from being the most expensive. And in terms of other growth factors, I mean, this is just well known. We're talking about a mega economy. Texas is the second state to now break 30 million residents and growing. And there's just unprecedented amount of migration going to Texas on a daily basis. Last we've checked, it was around over 1,400 individuals coming into Texas to settle a day, right? Just think about it. 1,400 individuals, they need places to work, they need places to buy things, and obviously need places to live. We can go on and on about the sectors of employment, but we obviously are very conscious about what sort of an employment sector we're looking for. We want to stay away from what we call one-horse towns. We don't want anything that is sectored around one specific trade or one specific sector. If that sector takes a hit, everybody suffers. We want to see that it's kind of like very evenly played out, and certainly Dallas is one of those locations. There's more information about it, a little bit about our operating partners. So the operation that we've done a joint venture partnership with American Ventures. They are the ones who are running the day-to-day. With them, they have a management company. This is the group, and then they have plenty of experience in multiple projects throughout Texas that they've done over the course of many years. So they're very familiar with this type of assets and managing those type of assets. In place we have United American Group. This is a group that's been around for since 1995. Also makes it over 30 years. They have multiple locations. They manage multiple places. They have over 50,000 units that they're managing, and we're very lucky to have them. Good people. Premier Leaders, we've hired an asset manager. Part of our operation is to make sure that somebody visits the property and make sure that the grounds are doing okay, renovations are going according to plan. Kind of like keep our eyes around. I'm there quite a lot, once a month roughly, and then eventually once we stabilize, go back to once a quarter. However, we have our asset manager that's visiting the site now going to be several times a week. Up until this point, it's been once a week. Going forward, because we're doing a lot of renovations, we're infusing a lot of capital, it's going to be 3-4 times a week, making sure that we're on site, we're hiring more staff. It's going to be a whole thing. So a little bit about us. Astor Realty Capital. I've started Astor some 7 years ago. I've been around the block for about 28 years, almost 30 years. Time flies when you're buying and selling real estate. I've done multiple projects. I've done well over $3 billion work with large companies. And sometime around 2024, I've decided to sort of like switch my focus. And instead of being, big money's advisors, I became the advisor for my own capital and for that is my friends and family. Eventually, we teamed up with another public company from overseas to help us kind of like expand the operation. And so we've embarked on this mission to put capital out, smart capital out in great projects. I have to say, with everything that we've been going through, everyone, all right, over the last 3 years, since 2020, everything that you can think of, pandemic and everything you can think about closures and increases in cost and inflation and now bank runs. Our portfolio is, thank God, doing extremely well. We're hovering around 23% on average. And, I think we're looking pretty strong. And the reason is because we have a lot of discipline. We don't go after projects that we don't have to. We review a lot. We review over 700 transactions annually. We say no to about 99% of them for a variety of reasons. We only take the ones that we feel that we can, first of all, minimize the risk and manage the risk. Manage the risk means the possibility of losing capital is non-existent. If we think that there's a possibility, and of course, people tell me, Joe, there's always a possibility, right? I'm not talking about, things outside of anyone's control, right? Not talking about some black swan event that nobody can predict or nobody can see, but as far as we can take, minimizing risk to the level that we can manage. If we're building condominiums and the market tanks, can I sell it? Can I rent it out and keep the property and maintain my expenses and my mortgage? If the answer is no, we abort. Can we increase rents in Arlington? Can we, from $1.20, move up to $1.55? I don't have to be at $1.75, but can I move up to $1.55? If I believe I can do it, great. If I can't do it in any reason, we'll stabilize and we'll maintain capital as it is. So preservation of capital is extremely important. So I've been doing it for many years. I also have a real estate school, a national real estate school, which is quite interesting in itself. And that's what we do. We live and breathe real estate. In fact, if you ask me, I see the world divided into two areas, those that are investing in real estate and those who wish they did. And so I hope that you will join us in this investment. This is our good-looking team of individuals that's been with us. There's a larger team. This is only some of the forefront corporate leaders. When it comes down to Astor Realty Capital, we have a much larger team of originations and research and so on that obviously doesn't appear here. A little bit about our projects. As I mentioned, we have a lot of operations in various markets, over 3.6 million square feet. You're welcome to go to our website to see some of our recent transactions. And, I'd like to open it up right now for any questions. And if you want to talk to me in private, or any questions in private, I'm happy to address those as well. I see we have a good number of questions. So let me see what we got here.
Joe, we do have one question from Richard. Would you mind going into a little bit more about the breakdown of the 12%?
Sure.
What's being accrued and what is being paid current, and the reason for those
Sure.
numbers.
Absolutely. Let's go back. Give me 1 minute. Okay. So on a $50,000 investment, we'll anticipate that the investment will last for about 18 months. It will accrue at a rate of 1% per month. Some of it will be paid to you ongoing, and some of it will be paid to you at the exit when we sell the property, right? So the way we have it down is we have 8% that's paid ongoing on a quarterly basis. $50,000 invested will mean that you get about $1,000. You can elect to do it on a monthly basis. It will be $300 and change, or on a quarterly basis, or on an annual basis, or you can accrue the entire thing at the back end. It's entirely up to you. So that's how we've structured it. Why did we structure it like this? Because we're mindful of our own expenses, and we want to make sure that we're able to pay a big chunk of that interest rate of the 12% as we go along, and then a portion at the back end when we're ready to sell the property. In any event, this is a corporate loan. It has precedence. We cannot take any money before our investors on the preferred position, this position, are able to get their money back and a 12%. Any other questions?
That is it from our chat feature. Guys, I would like to open up the
I see there's another
opportunity.
question here. One second. I see there's another. Can you have a slides or the financial report so we can take a further look? Let me see which one we're talking. This is from Hong Chu. Proforma, is that the one we're looking at?
Yes, to clarify Hong's question, yes, we will be sharing the full package and the recording of the webinar post webinar. Joe, we do have another question here. Why is Astor utilizing, I think this is a great question, why is Astor utilizing this approach instead of a capital call with current investors?
Wonderful question. The way we structure every operating agreement, we always look out for our investors that in the event there's a capital call, Astor's investors don't have the obligation. They have the right, but they don't have the obligation to participate in the capital call. So what does it mean? So let's talk about what is a capital call, right? So we raise a certain amount of money, we bought a certain property, or we're building a certain property, and something happens. Interest rate goes up well above what we've all expected. Something happens. There's another $1 million that's needed. Where do we get the $1 million from? Typically, our operating partner and ourselves will reach out to you, the investors, and typical, not on our case, but typically an operating partner will reach out to the investor and say, hey guys, we need $1 million. Based on your shares, each one has to participate, or will dilute you, will reduce your holding in the property, right? So every time they do that, a dilution mechanism happens. We don't like dilution, and we don't think that for the most part, it's a fair thing. You might be finding yourself in a position as an investor that you may not have the right money at the time, you may not be ready, any one of those different things. They tend to be super quick. And so we've literally none of our operating agreement have dilution mechanism in them. However, how do you get the $1 million? So we push this mechanism on our sponsor, and we say, you, the sponsor, has to be responsible to generate this $1 million. You can go to a third-party bank, you can go to your outside investors, you can go to your own pocket, and you're going to get a coupon. You're going to get an interest rate for that money. So in fact, in essence, there is a priority on that capital, right? So the priority becomes money goes back first plus whatever return. It will reduce the return overall to all the investors that are in the common equity. However, the percentage share will not be diluted. And that's the case here. We've struck the deal with the sponsor, and realizing that he doesn't have quite the capacity to go out, or we didn't like the type of capital that he was able to bring to the table with the way he was attached and the strings, we decided to go to our own investors. Now, initially we were thinking about $2 million. We've dropped this idea. We're now looking at around a few $100,000, $600,000. We as partners are willing to put our money into the same pot, just like everybody else. We're creating our own preferred position as well. And so, we're giving you the opportunity to participate in this deal and to essentially enjoy the coupon and the priority of payment throughout this program by creating the preferred structure, the corporate loan preferred structure.
Wonderful. Thank you so much, Joe. And thank you, Vishal, for that question. I'm sure that answer gives our investors here a lot of security and insight into Astor's morals and principles. Now, Joe, I have a question here from a newer investor. How are Astor's investors treated in the investment? How do we structure our investments, and how do our investors participate into an investment with Astor, and how does that affect any depreciation come tax time?
Yes, I understand the question. So there's no depreciation. You don't have ownership units. What you do have is our entity will have a corporate loan, which we will sign, and you are becoming a form of an unsecured lender, a corporate loan lender to our entity. So there's no depreciation, there's no ownership stake in this, but there is an agreement that as a corporate loan, you are entitled to get paid first, prior to any other common member, GP or LP or otherwise.
Beautiful. Thank you, Joe. And David, I hope that answers your question. Joe, can you walk us through a little bit about what happens if we extend an 18-month period? Are there any contingencies in place if interest rates potentially aren't favorable?
So if we need to extend, we are giving ourselves 1 or 2 6 months extension, and every extension will have to put additional reserves, right? So in this point, we're taking not just the amount that we're borrowing, but we're also borrowing on top of it the interest reserve. So we're going to have to replenish the reserves, and we'd like to do it with a 6 months increment. So in the event that in the next 18 months we'll need an additional few months, we'll take an extra 6 months. It will be our options as borrowers, and we will essentially plenish their reserve so you can keep on making your monthly payments. Obviously, the corporate loan will grow accordingly. We will issue the proper documentation, and we'll move forward accordingly.
Beautiful. Thank you so much, Joe. Will we be capitalizing a preferred reserve to service the current pay component of this pref raise?
Yes, of course. That's exactly what I said. We're in the amount of capital. We're not just relying on the income stream. Right now, we're collecting about $210,000 a month. We're anticipating to reach $300,000 a month. At that point, we're able to pay expenses, debt service, and have enough cash flow to even pay the reserves. However, we're not relying on that. We're creating an own interest reserves in order to have this ready for us to make the payments, so we're always current and you're getting your checks on time.
Beautiful. Thank you, Joe. And as we are adding a new entity as the pref investor, Matthew, to answer your question, Joe, who will be the managing member of this preferred equity investment?
So we're going to be managing both. We're going to create structure. It will be information given to the investors through our asset management, the same information that our common equity members are getting, the exact same information, collection, information about changes in the properties, information about occupancy and all those different things. You'll be getting the exact same information. We'll have an outside, I believe we'll have an outside, or maybe potentially we'll do it internally through asset management that will handle all checks and all the K1s and everything else that needs to come by. Any questions, you call our company, Astor Realty Capital. We'll work to see if it may not be Astor, maybe one of the other partners that will manage that, but we'll make sure that you have one source for that.
Wonderful. Thank you, Joe. So as of right now, that is it for all of our live questions. If anybody, of course, has any additional questions post webinar, you have my contact information. We're just going to come to the last slide here with that information. But Joe, do you want to share some final words?
I think we've covered a good amount of grounds here. Laura prepared a little QR code that you can download the information, get more access. Feel free to reach us. Have any questions? We'd love to work with you. And there's more opportunities that we're working on. And so what we always recommend to our investors, both current and new, your money out there in the bank is not doing well, right? It's keeping it in the bank, it's eroding to the tune of about 7-8% a year. So that's not a good idea. Keeping the money in the stock market, I know, because some of my money is in the stock market. It's, sometimes it's hard to sleep at night. It goes up, it goes down almost with no rhyme or no reason. It's very hard to track, and I think it's extremely risky. Right now, real estate is at a low point. It may go down a little bit lower, but I think it's at a very low point. And so now it's our time to go into the market and to start picking up some really good deals, which we are. I'd love to be in touch with you, and I'd love for you to join us on our next investments. If you have a certain amount of capital that you're intending to invest, and investing with us is something that is of interest to you, think about it this way, create your own portfolio. You can do it in small increments. If you have $1 million to invest, you can break it down over the course of 5 deals. If you have $200,000 to invest, you can break it down over the course of 5 deals, 4 deals, you name it. You can create yourself a beautiful portfolio. We're going to be going back to the mode of presenting a deal now at a rate of about, I believe, once every 45 days or so, 30 days, 45 days. You'll have plenty of opportunities. One of the things that's good about us, you're not dealing with computers. This is not a click here, send the money there. We're not crowdfunding. We are real individuals. We've been around the block for many, many years, operating in one of the toughest markets in the world, New York City. We're now diversified into 3 main areas. Our offices are in New York, in Florida, and soon to open up an office in Dallas as well. We've seen market cycles. We know how to handle market cycles. A lot of our focus is going to be similar to this, preferred positions. And I think that, with that said, any other conversation you want to have with me or any one of the team members, as we have a lot of new individuals here, please know that we are reachable. Okay, you're not dealing with an AI, and you're not talking to some sort of send me an email and deal with my executive assistants overseas. This is all local. We're right here. We're boots on the ground, and we'll have to find ways to work with you. And our experience is folks start with us, and their confidence in us grow over time as they see the progress, as they see money come back, as they see returns come back. And I certainly hope to have a meaningful relationship, because those things tend to go over many, many years. The trust is built over many years, and they tend to last over many years. So we take them very seriously. We want to know each and every one of you. Thank you very much for joining us today. I wish you a great rest of the week, and please reach us quickly, because the units of investments will probably fly off the shelf fairly quickly. Thank you again, Laura.
They will.
Take
Thank
care.
you all, everybody. We appreciate your time, and we're looking forward to connecting soon.